Hi everyone, and welcome back to A Smarter Way to Retire. I'm Tony Leonardi. I'm your host, and today we're diving into a topic that's absolutely essential when it comes to building a retirement plan that you can stick with. We're talking today about measuring your risk tolerance. When it comes to investing, we often hear the phrase, no risk, no reward. And while that's true to some extent, taking on too much risk can lead to sleepless nights and emotional decisions that derail your financial future. On the other hand, if you're too conservative, you might not grow your money enough to sustain a long and fulfilling retirement. The way I like to explain this risk versus reward paradigm to my clients is that when you decide to invest, you are making a conscious decision to purchase risk. That's what you're doing. You're purchasing risk. And you hope that you'll be adequately compensated for the risk that you purchased. I often ask this question of my clients: how much risk did you purchase? Can you quantify that for me? Because how can we determine if you're being adequately compensated for the risk you purchased if we can't measure how much risk you've purchased? How many of you out there can truly say that you can confidently quantify how much risk you purchased in your investments? The answer is typically, well, I think I'm taking on a moderate amount of risk, or not too much, but not too little. Somewhere in the middle. Moderate is the typical answer that I get. Well, how do you know that? And how do you measure that? So how do we measure risk, and how do you strike that right balance between risk and reward? That's exactly what we're covering today. By the end of this episode, you'll have a clear understanding of what risk tolerance really means, how to measure it, and how to align your investments with your personal comfort level and long-term financial goals. So let's get started. Why risk tolerance matters. Well, before we get into the details, let's talk about why risk tolerance is so important. At its core, risk tolerance is about how much uncertainty you can handle when it comes to your investments. It's the balance between how much return you want versus how much loss you can emotionally and financially endure without making rash decisions. The stock market is unpredictable, let's be fair. Some years it surges like it did last year, and other years like 2008, 2009, it takes a dive. The question is, how will you react when the market drops 10, 20, 30, 40%? Some investors can handle big swings without breaking a sweat. Others see a 10% drop and panic and sell everything. Your reaction to market ups and downs will directly impact the success of your retirement plan. We like to say that the key to long-term investing is time in the market, not timing the market. I'll say that again. Your success is based on time in the market, not timing the market. Think about that one. That's why getting clear on your risk tolerance before making investment decisions is so critical. It ensures your strategy is something you can stick with even when markets get volatile. So measuring risk tolerance isn't just about emotions. It actually has three key components. The first is your emotional comfort with risk. And this is what most people think about when they hear the term risk tolerance. How much market volatility can I handle before I start to worry or worse yet, panic? So some questions to ask yourself. If the market dropped 20% tomorrow, what would you do? Think about your portfolio. If you have $1 million invested today and tomorrow you lose $200,000, what would you do? How would you react? Do you check your portfolio every day? Are you comfortable writing out the ups and downs of the market? How did you react to the past market downturns? Loss aversion is actually a concept from behavioral finance. Studies have been done that found that people feel the pain of a loss about twice as strongly as they feel the pleasure of an equivalent gain. So in other words, losing $100 hurts roughly twice as much as gaining $100 feels good. And obviously, as the numbers get larger, the pain gets larger. And this explains why investors often make emotional decisions like selling after a market drop to avoid further losses, even if staying invested would have been a better long-term choice. Another way I know that people feel loss much harder than they enjoy gain is that my phone rings about 100 times more when the market goes down versus when the market goes up. So that tells you something about loss aversion, doesn't it? This is exactly what we're trying to reduce or eliminate if possible. Those sleepless nights that worry about loss or the concern about running out of money. We're back to that same basic question. Am I going to be okay? Or will my family be okay? If volatility makes you extremely nervous and prone to making quick emotional decisions, perhaps a more conservative portfolio might be a better fit for you. If you're someone who understands that short-term swings are part of long-term gains, you may be comfortable with more risk. So that is your comfort with risk, or what most people can consider to be your risk tolerance. Now let's move on to what I call your risk affordability. Even if you're emotionally comfortable with risk, you still have to consider your financial situation or your risk affordability. Think about it. If your time horizon is long, let's say you're in your 30s or 40s or even 20s, you have time to recover from market downturns. You can afford more risk. If you're already retired, you may need more stable income. Maybe you can't afford to take that extra risk, even if you're comfortable with the concept of market fluctuations. Consider your savings and income sources. Do you have enough in assets and cash flow to ride out market fluctuations? Or do you need your investments to be more predictable? If your assets are sufficient, maybe you can afford to take more risk, even though you don't need to take more risk. So consider your expenses. If most of your expenses are covered by Social Security or a pension, or as we say, your fixed expenses are covered by fixed income, you may be able to afford to take more risk. But if your portfolio is your primary income source, and you rely on that portfolio to pay your bills, a more balanced approach might be necessary. So think not only about your tolerance emotionally for risk, but also your risk affordability, which may be even more of an important factor in the long run. So we have risk tolerance, we have risk affordability. Now let's talk about your risk need. What are you actually investing for? If your goal is long-term growth and you don't need the money for 20 years, you can afford to take on more risk. If you're in retirement and you need consistent income, your portfolio should reflect that need with a mix of stocks and stable assets like bonds or annuities. Another way to look at this, how much return do you need in order to make your plan work? On the flip side, how much risk or volatility can your plan absorb without putting your long-term goals at risk? So if your plan works with a conservative 4 to 5% return, then there's really no need to take on any additional risk or chase higher returns. That could put your plan at risk. On the other hand, if you need 7 to 8% returns to meet your goals, being too conservative can put you at risk of running out of money. So you really need to have a handle on your risk need. What do you need to make your plan work? So what happens if the return you need doesn't match your emotional risk tolerance? If you need a higher return than you're comfortable with, you may need to adjust your plan. This could mean saving more, spending less, or maybe even working longer. If you're taking more risk than necessary, you might be exposing yourself to unnecessary volatility that could derail your plan during a downturn. This is why financial modeling is so important, which we've talked about before. It helps you determine the right mix of risk and return for your own personal situation. So we have risk tolerance, we have risk affordability, and we have risk need. Understanding these three components, emotional comfort, financial ability, and investment goals, will help you determine the right risk level for your situation. Remember, more risk doesn't always mean better results. Many people assume that if they need more return, the answer is simply to invest more aggressively. But here's the catch. Seeking out more return also increases the volatility in your portfolio, which can actually reduce your probability of success, which we'll talk about more in our next episode, probability of success. How can an increasing risk and return reduce my probability of success? Well, because the more volatility you have in your investments, the bigger swings in value. If you're withdrawing money in retirement and a major downturn hits early, it can cause lasting damage to your portfolio that higher returns later on might not fix for you. We call that a snowball effect. You want to avoid that snowball effect. We can measure risk and volatility in a portfolio, and we can predict how much volatility you can expect to experience from your portfolio. We measure risk and volatility in a portfolio using a few different statistical measures, but the most important, in my opinion, is standard deviation. Standard deviation in an investment portfolio measures the amount of variation or volatility in returns. A higher standard deviation means returns fluctuate wildly, indicating more risk. A lower standard deviation suggests more consistent, stable returns. I know we're getting into high school statistics here, which you thought you'd never see again after graduation, but here we are. Remember, one standard deviation represents approximately 68% of your results, while two standard deviations represent about 95% of your results. Is this ringing a bell? For example, if a portfolio has an average return of 7% and a standard deviation of 10%, its returns will typically range between 3 and 17%. That's one standard deviation, or about 68% of the time. If you want to be more precise, you can use two standard deviations, which represent 95% of results. And in this example, this portfolio could potentially lose 13% in a bad year. Understanding this helps investors gauge how much risk they're taking relative to expected returns. So which portfolio is better for you? The one with a 7% average return and a 10% standard deviation? Or the one with a 7% average return and a 5% standard deviation? So we can measure volatility with standard deviation. The thing that we can't predict is, when will you experience this volatility? Will you experience a lot of volatility early on in your retirement, or will you be lucky and not experience significant volatility until later on in life? We know it's coming, we just don't know when it will arrive. This is known as sequence of returns risk. If the market drops 30% in the first few years of retirement and you're pulling money out at the same time, your portfolio might not recover. It's like a snowball, which we talked about earlier. Your neighbor or your brother-in-law might get the exact same average rate of return as you do, but if one of you gets early volatility and the other gets late volatility, you're likely to end up in entirely different places in the end. So the key is not just maximizing return, but finding the right balance between growth and stability, so your retirement plan stays on track no matter what the market does. Understanding your risk tolerance isn't just about comfort, it's about making sure your investments are aligned with your long-term plan. So here's your action plan. Determine your required rate of return. This should be based on your actual financial plan, not just what sounds good, and use the modeling, if available, that we talked about earlier. Assess your true comfort with risk. Past market downturns can be a great indicator. Align your investments with both your risk tolerance and your needs. Taking too much or too little risk can both be dangerous. If you're unsure about any of this, let's talk. Reach out to me. Let's make sure your investment strategy is built for the long run. Thanks for joining me today on A Smarter Way to Retire. Be sure to subscribe, and if you found this helpful, share it with someone who's planning for retirement. Thanks again, and see you next time.
Securities offered through Mosaic Wealth, Inc., member FINRA, SIPC. Mosaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Mosaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Mosaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regards to your individual situation.